Hello everyone and welcome to TTT Markets. In this video, we are going to discuss why liquidity matters more than most retail traders think. Consider this. Most retail traders, they focus on indicators, patterns, news, and their entries. But professional traders, they pay attention to something else, and that is liquidity. Because liquidity is one of the main reasons price moves the way it does. And once you understand this, a lot of market behavior starts making more sense. You begin to understand why breakouts fail, why stops get hit before reversals, why price moves aggressively into certain levels. So in this video, we'll break this down directly on the charts. So we are going to use EURUSD and dollar yen. And we will go to the chart straight away. Let's take a look at this hourly chart on the Euro USD. And let's focus on this area right here on these highs. Can you see how the price has been rejected in this area multiple times right here? So what happens? Retail traders see this and think, well, if price breaks above, it will continue higher. Or it might be rejected here, so let me just place my stop right above. So two things happen. They are doing two things. Number one, they will start placing buy stops just above the highs, thinking, well, if we get a breakout, that will continue higher. Or they start selling and they are placing stop losses above the highs. So liquidity starts building here. Now watch the price. Take a look at this one, for example. If price pushes above the highs, it triggers the breakout trades. It hits stop losses. And then suddenly it reverses lower. This is a classic liquidity grab. Price moved into the liquidity first, not because the breakout was wrong, but because the market needed orders there. So I will repeat, it goes here, there are breakout traders, but they think, well, this is the high, let me place a buy stop order right here, because if this breaks, it can continue higher. Then there are others that think, well, I will place a stop loss here and I will trade the reversal. And they place the stop loss very close, just above the previous high. So what the price is doing, it needs the liquidity. It goes for the liquidity. This is the classic liquidity grab. So it goes here, it triggers all the buy stop orders and the stop losses, and then it reverses. Keep this in mind. The market, 6 areas where large amounts of orders exist. It needs orders. And equal highs, equal lows are very common liquidity zones. Let's take a look at the dollar yen. So I'm going to open here on TradingView dollar yen. Let's take a look at this. I have the Fibonacci from a previous analysis. Let's get rid of this and let me move to the 4-hour chart so you can see this better. Again, similar example, what it is doing here, previous high. Can you see this? We have a ranging market, we have the highs and we have the lows. So there are orders, breakout orders above the highs. There are stop losses from people that have sold and they think, well, if price moves above, I better stop. And what does the price do? Fake breakout, it goes here, it needs the orders. The orders are triggered, stop losses, buy stops, and then what? Boom, it goes down in an emphatic way. So why this is happening? Why this area? Because this is the logical stop placement. So liquidity is building above this level. Or would you like to see another example? Let me turn to candlesticks so you can see this better. So there you go, we have candles. This is the 4-hour candle. the price is dropping. And this is an important area. I am not using any indicators now. This is a support zone. Look what happens. Once, twice, 3 times, 4 times. Can you see the wick? Look at this area right here. If I place an horizontal line, let me do this. Okay. So what happens below? The price stops here once, twice, 3 times. So what do you think will happen below this level? We have sell stop orders. There are traders thinking, well, if this is broken, it will continue lower. But there are guys that have bought here, there are traders that have bought here, and they have placed stop losses below. So there are both buyers and sellers that have an interest in this area. So the price needs to reverse. There are news, there are fundamentals, there are central bank news, whatever reason. But it needs the liquidity. It needs to grab the orders. So what is it doing? It gets down here in this zone, triggers the sell stop orders and the stop orders from the buyers, and then it reverses after it grabbed the orders. And then the trend is changing again in a more dramatic way, in a stronger way. It goes all the way up. So it moves below the low, stops get triggered, weak longs get forced out, and then suddenly it reverses aggressively higher. And again, this is another liquidity event. The market moved into liquidity before continuing in the original direction. So why does this matter for traders? This is changing how you view the market. Instead of thinking, where should I enter? You start asking, where is liquidity likely sitting? Would you like to see another example with, let's say, Aussie yen, because the last few days we had some risk off, stocks were dropping, we had news. So look at this again. So this is the 4 hour. These are highs. We have a high here, an important high here, another important high there. So what do you think happens just above these highs? There are traders thinking, oh, this is broken. Let me buy because it will continue higher. There are others that think, well, let me sell here and I will place my stop just above, thinking they are taking smaller risk if they place a stop for a few pips just above the highs. So the price is getting here first, and then it is doing what? It reverses to the other direction in a stronger trend, in a stronger manner. It goes up, again there are news, it comes here slightly above the highs, it visits this zone, and it reverses again. So you need to ask, where is liquidity likely sitting? Because if you understand this, it is changing your whole perspective. You start understanding why obvious breakouts fail, why stop hunts happen, and why price overshoots certain levels. Now let's connect this with volatility. And let me, actually, you know what, let me choose dollar yen, because we also had some events from the Bank of Japan. So I'm going to show you this, the 4 hour dollar yen chart. What do we have here? We have an intervention, we have a very large candle, we have fast movement. This happened extremely fast, a very strong movement, very fast. Most traders think news caused this. Sometimes yes, in this case yes, but there are other times that it is the liquidity that amplifies the move. Because once stops start triggering, more orders hit the market, momentum accelerates and volatility expands. And the liquidity is creating the movement. Why am I saying this? Because if you do just a basic resistance support analysis, what will you notice? So let me choose this trend line, and we have the highs here. So this is our price channel, and we have this here, So can you see the area, the consolidation area? What do you think happens below this level? There are traders again that are selling the highs, buy the lows, sell the highs, buy the lows. Maybe I need to place this here as well. It will be more accurate. So once we are breaking this level down here, yes, there are news, but this move accelerates because once this is broken, then the whole move is becoming more enhanced. The momentum accelerates. Why? Because there are new orders hitting the market. The news are important enough to cause the price to move below. And once this is broken, what happens here? We have buy stops that are triggered. We have sell stops. We have all different kinds of orders here that get triggered. So this move accelerates. And it is an important move. You look at the candle and you think maybe it's not a big deal. But this is a 250 pip move to the downside. It comes here, buyers get interested, start buying, comes back up, tests resistance, more sell orders, it comes back down again. So can you see how the volatility caused by the news, it is accelerating the movements, but this is all because of the liquidity. So the retail traders, they often place orders in obvious areas. For example, stops below recent lows, breakout entries above resistance, and tight stops near visible levels. So the problem is everyone sees the same thing. As I said, why do you think there is a resistance here? Well, do you see why? We have a resistance here. So everyone sees the same thing. And when too many orders cluster together, those areas become liquidity targets. So let's make this practical. Let me show you another range in EURUSD. So this is a range-bound movement in the EURUSD. So this is my range. Sell the highs, buy the lows. Inside the ranges, liquidity becomes even more important. Why? Because price often moves from liquidity pool to liquidity pool, stops above highs, then stops below lows. So this is creating the appearance of a random movement, but it's often liquidity that is driving behavior. So liquidity does not mean the market always reverses. This is important. Sometimes liquidity gets swept and the breakout continues aggressively. So the goal is not to predict perfectly. The goal is to understand where reactions are likely, where volatility may increase, and where risk becomes more dangerous. So how professionals use this? They don't watch the candles. They think about positioning, order clusters, stop placement, market participation. They understand that price is constantly interacting with liquidity. So you can see, for example, in this chart, the price moves towards liquidity, how and where the stops get triggered, and in which area the volatility may expand, and when the real trending move may begin. So the market is becoming much clearer once you understand liquidity. So liquidity matters because it explains behavior that many retail traders misunderstand. It explains failed breakouts, stop hunts, aggressive reversals, and the sudden burst of volatility. And understanding liquidity changes how you trade. You stop reacting emotionally and start understanding why price behaves the way it does. Because in trading, price doesn't just move randomly. Very often, it moves toward liquidity first.